another week's session of SMC meets order flow. Tonight, I want to go over discrepancies within fair value gap trading styles, right? You have a lot of different traders that have some great strategies out there based around fair value gaps, some great, some not so great. We have people like TJR teaches, to use them as areas of entry for support or resistance. I really used to trade myself, even the mech model by PB Trading, and I think that's a great strategy. If that's what floats your boat, then by all means stick to that. Although tonight I want to go over teaching people how to recognize which fair value gaps actually hold weight in confluence and why, if you are trading an inversion trade, isn't your take profit getting hit at a strong low or high price target. So here on screen, I've already mapped out what a fair value gap is on a volume profile. These are session volume profiles that start running right at market open and they run until New York close. This is the 1 hour time frame, right? So this is showing a whole day's worth of price action in a brief period, and then it restarts. Another volume profile for the following session, another volume profile for the following session. Okay, so a lot of traders definitely would have seen this 1 hour fair value gap get inversed, and they would have assumed, pretty rightfully so, that this 1 hour low behind my head here, this 1 hour low would have been a great target, and it is a decent target, but I can show you exactly why it didn't get respected and how to identify the areas of support and resistance that are likely to get used in your intraday trading session through a volume profile. Institutional traders and floor traders aren't really using fair value gaps in their strategies. They're just auction inefficiencies and imbalances that we've learned to recognize through SMC concepts and price action. And they do a lot of times hold weight. And the reason why they hold weight is a fair value gap gets created by very little participation, as my cursor is showing here. In this volume profile, we have a very low amount of volume within this very large expansion. So fair value gaps get created when the market goes from become balanced to unbalanced. So basically, price is always seeking efficiency, right? That's what we're always taught. And price is in a constant tug of war between longs, buyers, and shorts, sellers, as to what direction the auction is going to head. Each candle is an auction. Auction market theory is literally how the market operates. So we've got ourselves a low volume node right here. A ton of traders. This was right at 10 a.m. This 1 hour candle had closed inside of this bullish fair value gap. Even looking higher, in this time frame, let's see, we have market close from the previous session over here. We have, let's see if we can find ourselves. We have a small bullish fair value gap right here that acted as support for this following day's session that pretty much just consolidated. And we saw a lot of wicking, which is passive absorption and accumulation, what we get taught, right? Price is going to push in one direction, although it is getting absorbed by a large institutional player or a large money trader that is taking that opportunity at a specific price level to take a counter position. So it's causing large wicking and sporadic volatility that leads to a lot of stop outs. So this isn't a good session to be trading, but we were resting and using this 1 hour bullish fair value gap as support. So for a lot of people, and on that day's session, towards the end of the day, longs were a decent trade. And then we had reversed, right? We didn't have any clean, let's see, on a lower time frame, let's scoot down. On a lower time frame, market had opened at 6 p.m. right here. So this would be the Asia session trading hours, bearish Asia session, leading into a relatively bearish and consolidation period throughout, excuse me, the London session, and then New York pre-market. We had a pretty bullish New York pre-market. So a lot of traders would probably assume that we see this 1 hour bullish fair value gap, and they would have taken longs within this space if we had, let's see if we have a low time frame inversion out of that 1 hour fair value gap. I went to a previous session because I was able to find a relatively good demonstration, right? So now I'm on a 1 minute, which is a low time frame. But I know plenty of people that are just running off of 1 minute inversions and things of that nature. So we have 9:30 open is, I'm going to put a vertical line there. 9:30 open is all the way back here, right? New York tried to push higher. Realistically, people don't, unless you're using volume profiles within your trading, you don't know that price rejected the value area high after a bearish overnight session. A lot of SMC traders were probably anticipating on this day that this was going to be an open, low, high close scenario. Asia sets the range. London manipulated the lows and took sell side. And then you would anticipate for New York to potentially sweep a level of sell side or just expand and get a continuation play from there. But we had opened. We had a bullish open. We rejected value area high. Unless you're tracking a volume profile, you won't know that. And then saw some consolidation at the point of control. And some people may have at 9:45 taken this 1 minute inversion right here, which is a decent trade. They would have, if they were targeting these 1 minute lows, which I doubt it. Everyone that I know in this space is pretty ambitious and shoots for these pretty rocket ship trades. So if I had to guess on that trading session, traders, and mind you, this is all within it's probably within this 10:30 and 10 o'clock candle, right? So we had a short that ran down here, and everybody would have targeted at least, at the minimum, the next 15-minute low, which, being realistic, everyone in the SMC space would have said, oh, this is all low resistance liquidity, right? From here. This is on the 15-minute time frame. If they had said that this was low resistance liquidity even to this low, they still wouldn't have hit TP and price would have come back at them. Unless they were trailing their stop, they would have taken a break-even trade on that. So right here, I'm going to mark this low resistance liquidity. And this is all, I'm not knocking anyone's analysis. If this is how your trading style is without volume profiles and such, it's not, you don't, it's not that you're doing anything wrong. It's just you don't understand how institutional and smart money traders trade. They use volume profiles, volume weighted average price, and order flow within their day-to-day. You won't find a trader on the New York floor that's using FVGs within their style. They're using low volume nodes. And so when we look at this volume profile, this is a pretty scarce profile. This is very bullish expansion for a pretty little amount of participation. So inside of here, we have the point of control. This is the area where everyone is essentially agreeing that it's the highest level of participation. That's where you'll always find consolidation within the chart. And that is, everyone is in the tug of war and agreeing that this is fair value for the asset or the equity class that you're trading at that time. Whatever it may be, you could be trading a stock, so on and so forth. That's where everyone is agreeing this is fair value. And each session has a point of control, which is the largest volume, and it creates low volume nodes, inefficiencies. And so certain inefficiencies hold more than others. And institutional traders are taught through college education. Unlike most of us, a lot of our trading habits began on YouTube and learning from other educators within the space and Some of us have really managed to become fantastic traders through that avenue, so definitely not knocking it. I myself have pretty much all of my education through other traders and then further deep research. But so let's say the target of the day was that short or a long out of here. Regardless, if you took a long out of here on a lower time frame, you were getting smoked at your stop loss. That would have been considered a stop raid. You saw a light inversion. We didn't take any highs, and people would likely blame it on we were just generating liquidity, or it was a stop rate, or so on and so forth. And really, it's you're not understanding the auction, and that's what's leading to the stop rate. So here we have 15-minute sell side liquidity. That would have been my target after, potentially getting knocked out, or if I took a long out of this 1 hour fair value gap, my target would have been, at the time, this was all-time highs. So all-time highs or buy side, I would have assumed we're ripping right back up there. Why did price dig down here, even past this value area low? And the reason being is because on a higher time frame chart, this is an area of demand. And institutional traders are taught through college education and even in options trading, and everybody relies on supply and demand. And there's a way to know if your areas are valid or likely to not hold weight. But to mark an area of demand or an area of supply, in this case, an area of demand where everyone is trying to purchase and take longs from, you would mark, the bottom of a candlestick or the bottom of a wick, whatever you prefer, to the first low that gets created. I generally will go to the candle body's low. So we have an area of demand right here, which would also line up with what everyone gets taught through optimal trade entry, a 75% retracement back into an area of demand. So we didn't take any lows. We didn't run this sell side liquidity. But what stopped us within this area of demand? And how would you know that this is going to hold weight? The reason you would know is because on the volume profile, paired with this area of demand as well, we have multiple stacked low volume nodes. Even though we have a huge inefficiency right here where price became very quickly imbalanced, and we know that price is going to at least paint back over that inefficiency and essentially patch it. It doesn't mean that it's going to become support or resistance in that following session. It's an inefficiency. If you have low volume nodes resting below that area, you can almost always guarantee that this higher time frame FVG is not going to be the end of the line. In this case, we didn't even tap in to this unmitigated 1 hour, or we actually just tapped it, I believe. We did. We just wicked into it. So I'm sorry. In this case, we do have a 1 hour bullish fair value gap, which is the first presented fair value gap as well. That lines up with optimal trade entry. But we see price didn't reject this breaker block that we have right here. You could mark the first 3 candles however you like to do it. I will generally just mark the last candle in the run. And I'm sure ICT would tell me I'm doing it wrong. But all in fun. I have a lot of respect for Michael Huddleston. But right here we have a breaker block. Also disrespected that. So most people too, as soon as we close below this, we have stacked imbalances. So I can't speak for you. Some people might recognize that we're tagging into an additional 1 hour and that we're likely to retrace out of that. But a lot of traders would think if we're disrespecting this huge area of rejection right here, then price is definitely going to continue more bearish after this huge waterfall dump off within a 24-hour period. But in this case, what really happened, and what happens every day, is we tapped into an area of demand, which in finance school and so on and so forth, I didn't attend. I just have a lot of friends who did, and I've done a lot of research, and this is how they are taught, is areas of supply and demand. And throughout everything, business, so on and so forth. There's always a supply and there's a demand, and people are running metrics based upon that. It's the same thing within the charts. And so here we view price being below the volume weighted average price, which is reading to us that price is in a discount now. When price is above the volume weighted average price, it is in a premium. And so if we came into this 1 hour fair value gap and we didn't just immediately reject that bullish 1 hour fair value gap with passive absorption, which is you can recognize by a large wick or volume aggressor bubbles, however you like to. I read volume footprint candles, so at the exact same time I can gauge that it's actually passive absorption and it's likely to continue. Large wick, next wick off theory. You know, a lot of people trade rejection blocks. Right here you have a rejection block, and in this candle we opened and dug down into it, and you could have gotten a great long out of that rejection block. But in this case, people were probably losing their minds and they don't actually understand what's happening within the charts. So on a higher time frame, we had ran up, we dug back down, back into an area of demand. We didn't sweep this low resistance liquidity and all these other things of that nature. This was just a tug of war after an expansion prior to having price becoming imbalanced, right? We were sitting at the volume weighted average price, meaning for that time, that asset was considered balanced up at this little level of accumulation right here, where we have some rather choppy price action, and we then became imbalanced. And so after this, we've now created this session's volume profile. And what happened at the next session? Price immediately tried to rebalance. It opened low and it dug down to the previous session's point of control. And then we went and pushed higher. And so at this time, you know, we have a new day opening gap, which those are great draws. I'm not going to knock those. I still use those. As long as order flow pairs up, I will go take the trade to fill the gap. That is a widely done thing. And so new day opening gaps, new week opening gaps, great draws on liquidity. But if you're wondering why your higher time frame lows and highs aren't necessarily getting taken in your trades, this is why. You're hitting areas of demand and areas of supply or key levels on a volume profile where institutional traders are stepping in for opposing trend trades. So let me delete that. 9 a.m. That was 9:30, but we're on a higher time frame now. Let's go down to the 15-minute. So on a lower time frame, right? A lot of traders might see these low volume nodes here, and they're not paying to a previous session that pairs up with it. And we have obvious draws lower. And so higher time frame narratives are very, very important. I know for a fact in my earlier days of trading, I would 100% have had high conviction that all of this low resistance liquidity is going to get taken, and we were at least sweeping these 15-minute levels. So if I was in shorts, I'd be really disappointed. This would be one of those times that you come just a couple points away from hitting your full TP. Most people would be targeting these lows, and they would anticipate price to just dump and flush. You know, we had closed below a 1 hour bullish fair value gap. We're expecting a huge flush now, and really we did have another little dig. We dug about another 200 points, roughly maybe another 250 if I was to measure from that candle's high. So either way, I'm not measuring this perfectly. Roughly 250 points. Great little move, easy to capitalize on, but we can see we have some consolidation right here. And the reason for that is because in this session, that was the value area low. So a lot of traders were already stepping in to take opposing trend trades, either to value area high or the point of control or previous session's key level. This probably would be a very, very frustrating day for a lot of IFVG traders because with patience, you would have hit. But look, this is during the day, if you had seen this right here, we tagged in here. Say you came down here and you missed your level, and now you're holding this short. By the time it came back and you got tagged at break even, most inversion traders would have taken a short on a lower time frame after seeing the 15-minute candle close below this gap. Rightfully so through SMC concepts. And gotten in a short here, very, very choppy, didn't hit their key level for take profit, and instead just came back and gave them a break-even trade. So in this case, it would have been break-even, and by the time you're all the way up here, if you took a counter trade thinking that we were going to take at least these highs that we created at 9:45, you would have hit the end of the session just consolidating and either had to close prematurely or just not taking a trade at all, and it's just a red day for you. And in reality, price during, the New York session, if I was to put a fixed range profile, volume profile from here, 930 to, let's say, down here, I can't understand why this does this on TradingView. It just measures everything forward from that moment, and it's supposed to calculate that. So either way, I add a fixed range profile at the beginning of every session, and I will be watching it, and I won't take any trades until at least 15 minutes into the session. And a lot of times, like, let's move forward to Asia session tonight, right? We're about to open Asia. I chose to sit on my hands today. Really not bad price action overall for the New York session today. If anyone was trading, I'm happy if you hit. I can understand if you had some struggles because it was relatively ugly in the first, good 10 o'clock. It did have a nice expansion, and this was decent. We moved 388 points today. Good expansion. The rest of the week has been rather sideways, and so I've been really, really risk off. This isn't clean price action. The 4-hour chart looks pretty horrible if you ask me. I'm not very interested in trading in anything like this. This doesn't serve me good over my experience of trading. I like clear market structure, I capitalize on heavier risk in times like these, and I am very risk off with low position sizes in times like these. But so either way, I know that today I did witness a lot of traders that were immediately, anticipating bullish market structure, because we did have, on a 4-hour chart, we did have a 4-hour change in the state of delivery closing right pretty much at New York, right before New York opened. Right, let me go back and show you that so I'm not just speaking out of my butt and you can see what I mean. All right, so we were rather sideways, and then this morning at 2 a.m. we had a bullish change in the state of delivery on a 4-hour time frame. And so if we were to ignore these volume profiles, now let's get onto a lower time frame. So in the New York session, had immediately, this is super ugly. I really hope traders didn't enter until we saw at least a 5-minute inversion, because in that case, you would have ended up in the green for the day. But if you were on a much lower time frame, expecting, kind of the typical New York rocket ship opens that we've been seeing, like a 1-minute time frame, this is super ugly, and I could see a lot of people just getting annihilated in these times. We're sorry. At open, we were sweeping liquidity on both ends of the aisle. We had, pumped a little bit, dumped off. We didn't sweep. We swept very lower time frame sell side, just trying to talk price action in terms of SMC concepts. Let's see, even on like a 3-minute. On a 3-minute, we had a pump, small dump. Did we leave a 2-minute? We left a 2-minute bearish fair value gap. I'm pretty confident that there was probably a lot of people that ended up taking this candle's closure, entering at, either this candle's closure or this candle's closure with their stop at this low. And they were either targeting a 1-to-1 or just targeting previous session highs, which we actually didn't fully make it all the way to them. But good run after the fact. But so either way, shooting for either a 1-to-1 or a 2.61, so on and so forth. And not a bad trade idea, but this completely failed. And you would have gotten stop rated prior to having the expansion almost to your TP. But how you can gauge things like this, there could have been people who were reluctant and wanted to have seen either London lows get hit or a deeper retracement prior to entry. Did we tag into? I honestly didn't even look at the charts this morning. I really early looked at the higher time frame narrative, and I just was like, nope. I saw the 4-hour chart, and I started the week off losing about 1% between the two accounts. I made about 0.5% back, and I've just been super risk off anticipating Wednesday's FOMC meeting. And I do think, military action is likely in Iran. So there's very shaky ground. That's why we've been sideways. People just don't necessarily know what direction the charts are going to go. And so I like clarity. But either way, again, overnight session generated what we would know on a 5-minute chart. This is a ton of low resistance liquidity. So some people could have wanted to see these lows of Asia get swept, or an optimal trade entry play from, Asia low to the highs created in pre-market. And I can't speak for you. Everybody's trading styles are different in terms of using fair value gaps or SMC concepts. But I can tell you why. I can look back at price action. I can essentially gauge it and tell you what institutional traders were thinking, right? We have accumulation right at New York Open at the overnight volume profile, read that this area in pre-market had now become value area low. This very well could have been the point of control at open because of all of this consolidation, with value area low resting somewhere down here. We also had relative equal lows on the 5-minute sitting down here. So I bet a lot of people were hoping to see this sell side get run, these levels get hit prior to taking longs. They may have prematurely taken longs and just gotten completely annihilated off of a lower time frame, like 3 or 2 minute. And I want to stick up. Now, this volume profile is going to be kind of overlapping price action. If you were to set this, it would remain to the left of the price action while you're watching a session. But because the session is complete, it's now measuring everything within it. But we had run up to, I'll be able to find the level that we rejected and why we didn't take those highs, and how an institutional trader would have been looking at this, right? So when price is moving higher and higher and higher, we had New York AM high previously, but we have all of these draws higher. We have an unfilled, bearish 1-hour fair value gap resting above that. I didn't have the 1 in there. I just have this on my chart anyways, because I do believe this is a draw to see this get mitigated. I had it marked earlier in the week. But again, super ugly price action in my opinion. But we came up here, and what do we have to the left? We have got ourselves key rejection areas. But the reality of this is from this high to this, where we dug down and we retraced back up, this is an area of supply. how institutional traders think. So I have this an area of demand or an area of distribution or an area of supply, whatever you like to use. I just go by area of demand and area of distribution generally, but I'm saying supply and demand tonight to make it relative to everybody. So in reality, why you're not seeing your levels get hit is because traders are stepping in at these levels. You know, we do have bearish structure. We have a bearish 15-minute that got closed above. And so people would definitely be expecting continuation. Or in this candle, we very well could have just tagged it and retraced with passive absorption, which we did. We closed within this bearish 15-minute fair value gap. And this is why I do have a lot of respect for Michael Huddleston, because he is the first person ICT to have really studied candlestick price action so in depth that he has made it relatable to how an institutional trader is viewing charts between supply and demand and volume profiles, and they're looking at low volume nodes instead of fair value gaps. And what do we have directly to that session's left? A huge low volume node. So at this point, price was imbalanced, and we retraced back down to a session's point of control. We became balanced. We dug back down to value area low, and then retraced back up to the point of control. Went back down to the value area low, swept that sell side, and then blew through the point of control, retraced to VWAP, just below value area high. Where did we go after that? Back to the point of control. Next session, next day's session, we had opened. This became the point of control, went to value area low, and I guarantee you on a higher time frame, a 1 hour or a 4 hour, let me go to a 30-minute so we can actually still see the session boxes, right? We swept these lows. In reality, we tapped right back into that area of demand on the 1 hour that we have been targeting. This was Monday or Tuesday's low of day. That was Monday's. So Monday's low of day. Institutional traders are always also focusing on, they don't look at 1 hour highs and 15-minute highs and stuff of that nature. They look at high of day, low of day, high of week, previous week's high, previous week's low, and these are the levels they're trading off of. And again, absolute kudos to Michael Huddleston for being a beast, and he's created a system that works for a lot of traders. Although I personally traded ICT concepts for a decent while, and I really didn't get beyond the point of becoming a great break-even trader or a lightly profitable trader. And that's not going to be good enough if you want to do this for a living. You're going to need to have a higher risk to reward ratio, higher R trades, and a more consistent strategy. And so again, if you're able to do that consistently to the point that you're making a ton of money, I'm very happy for you. I'm not knocking it, but I'm just saying it's highly unlikely for other people to replicate it. And most people are charging money in their Discord spaces and communities, and that's how they're supplementing the remainder of their income. It's not actually from their trading. And so I just want people to recognize that everything rolls through supply and demand. 1 hour and 4 hour time frame areas of supply and demand formed a low. Even if you wanted to go all the way to this low and call it an area, right, on a 4 hour low. Now this is the area of supply on a 4 hour time frame, or area of demand, I'm sorry. That's not a coincidence. Every time it touches into this area, we have huge passive absorption for longs. Now, we're respecting this 4 hour area of supply at the moment, which leads me to believe that I can't say for certain, we very well tonight could reach up into this area of supply or area of distribution and mitigate this gap. Now on a 4-hour time frame, that's a 1. This is a smaller gap, and reject or retrace and balance this range out of that. It's hard to say. We're really sandwiched in between two key levels right now, but that's how you can play these more consolidated periods of time, is that you need to be focused on supply and demand ranges and not so much liquidity levels. Liquidity levels aren't exactly getting run at this time right now, and expansions aren't as clear for the last, at least week or two. Yeah, 2 weeks ago, we've been pretty sideways on a 4-hour. We did have some decent expansion. Last week's price action was actually pretty beautifully printing throughout every session. I had a great week. That's another reason I'm super risk off this week. But overall, it's not desirable. So the fair value gaps that are going to end up acting as support, just to keep in mind, or resistance, are ones that are paired with a low volume node. So inside of this bullish 4-hour fair value gap, I'm going to delete that other one. Let's make that box yellow. That's our low volume node, right? But it's resting right inside of a 4-hour bullish fair value gap. So this one, we have passive absorption off the volume weighted average price. We're likely to continue higher. That's what I'm seeing here for tonight's overnight session. We will most likely come and retrace back up into these key levels. We could reject this previous session's value area low, which pairs up with equilibrium and this 1-hour bearish fair value gap. Likely we will just tag into it and see passive absorption back down to balance this bullish leg, or we could very well dig deeper if we get some crazy war headlines or something of that nature. Overall, though, the FOMC meeting that happened today was predicting relatively hawkish, bullish periods of time. Or that always still gets me confused. I believe hawkish is looking optimistic, where they're not forecasting rate cuts immediately, just more so holding current rate terms, and they want to see inflation dissipate. I have high conviction that Kevin Warsh, the next Fed chair, is going to bring some seriously bullish activity to these markets. So if we do return bearish, I think it will be short term, and it would probably be due to Iran conflict. And then Kevin Warsh gets sworn in on, I believe, the 22nd. And he will be doing some, I'm sure, press addresses in due time, or the following FOMC Wednesday, where he'll get up and I'm sure have a whole different approach to balancing the rebalancing the Fed's balance sheet itself to try and dissipate inflation through other means that will then in turn lead to lower interest rates and super bullish periods for the indices. So I did want to point out how all fair value gaps aren't necessarily created the same. I personally don't really, I used to for a very long time. I do still look at fair value gaps for the sake of keeping things relatable to people that I'm teaching, my strategy to and how I trade, which is the TCP model. I also have a great video on volume profiles that I really go into depth about these, passive absorption and these levels, and I bring up the correlation between them. And I really recommend, if you haven't watched that and you're interested in this trading style, that you go check that out. It is very, very informational. And yes, it's unfortunate to see so many traders in these markets are really struggling. Trump markets are totally a different thing that we haven't really seen. This is intense volatility. It's either incredibly bullish or incredibly bearish. That's what we have noticed, or incredibly sideways. And so it's not desirable in the slightest. Let me see if I can, just before I wrap up tonight's session, I want to go into this on on a lower time frame the current Asia session and set up a fixed range volume profile, right? So now you can see how this is much smaller and it's not trying to measure a massive period of time. And I don't like to see on a 5-minute how, again, like this wicking, this is just bad price action. If you ask me, it's not optimal trading. I'm going to sit a lot of this stuff out unless we get clear trajectory. I'll be on live tomorrow for anyone that wants to join me, but it will most likely it will just be to offer my insight on price action that day. I don't necessarily know if I'll step up and take anything. It would have to be really good looking. So, you know, we have a low volume node on the volume profile, which is really the only low volume node that we are showing. So that's a great indication that price is going to come and rebalance itself right here. We have passive absorption, and relative equal highs or lows tend to show that we have a limit order wall. When price has reached that level, there is massive resistance because of the fact that there are large limit order pools resting at that level, rejecting price to go any higher. So we didn't even trade up into this fair value gap. Why? And others might be waiting on a short to come out of that fair value gap, but in reality, this is why volume profiles are so much more accurate. They're only applicable to the current session at hand in the current day's time frame. And price still returns. It's always good to have, like, I have unmitigated points of control. My settings map out like all of these yellow lines price has returned to, and that's why you don't see it extending off of the chart. Although, like right here, this is a key level that price is likely to return to at some point. We almost always return to those levels, but you can pretty much guarantee that price is going to return to this one first at the least. We are overall bullish in today's session, right? Yesterday's session, I'm sorry, now that we're opening a new day. But given this absorption, I think that we will return, balance this fair value gap here, 5-minute. This could now become support because we have an obvious low volume node on the profile showing and explaining why this inefficiency has become imbalanced. We are seeing passive absorption from value area high, passive absorption from this value area high. And you could also consider this. It's only 5 minutes, so I really wouldn't. I was going to say this would be an area of supply or distribution, but it's not really a high enough time frame for me to call it that. So let's go on to, yeah, even on a 1 hour, like this whole area would be an area of supply. So say on a 5-minute, the area to trade out of that I would really be interested in, which also would line up with OTE, would be right out of right here. We had an area of a rejection, a low got created, then we created our first candle of resistance. We pushed lower. So this right here became an area of supply or distribution. Price retraced back into it. No fair value gap, but it's a rejection area. Price continued lower. Where do we go? We went down into this area of demand. Price is now seeing bullish absorption from shorts within this range, and we are likely to push into at least this next area of supply. If we're going to continue lower, we will reject this out of this optimal trade entry style play as well, where we would return down to sweep previous session lows. Maybe not. We could reject true day open and trace higher. This is also all of these price legs. And this is why sideways trading is really not favorable for me, because there's just a million areas of supply and demand painted. So it's really a scalp trader's haven. I essentially am a scalp trader, but I like much more clear fluid PA than this. This is, again, not desirable. So we do have a key area that we know price is going to at least retrace back into. We could come all the way down to touch the volume weighted average price and this POC. We could reject this value area high at some point in this overnight session. I'm willing to bet that this bullish 5 is going to get retraded back down into. And this point of control at 29,310, this would be the next destination for price to be considered balanced, right? And so we have 6 o'clock open. We didn't leave much of a, let's go on a 1 minute of a new day opening gap here. Yeah, it's not much of a new day opening gap. If there was a larger new day opening gap, you would likely see previous point of control would be above that, and it would be a great explanation as to why price is reaching up to balance the inefficiency, and its target is going to be the point of control. That's just how it plays out consistently over and over and over again. Price came up, shorts, tapped down into, and as the day for continuation trades, as the day moves on, we have another area of demand right here. Price traded back down into it, took off. So now for continuation trades, building your position, price took off, showed consolidation. We formed an area of demand right here. Price started to take off again. It tapped back down into it, took off from there again. Now the next area of demand becomes this level. Price rocketed off with velocity. We didn't respect this area of demand. This was a huge inefficiency, so we're likely to come patch it. But we did respect this area of demand again and returned back to point of control. Value area high to point of control. Up, rejected right here. Area of supply. Shorts. Down to volume weighted average price, just about inside of this area of demand, showing that price was again becoming relatively balanced. The volume weighted average price will jump based off of how much price action I am showing on the screen. So as I move further, it is going to adjust itself to only the price action that is displayed on screen. So again, now we have opened and closed the day with relatively on a lower time frame bearish structure, but on a higher time frame we are bullish. So I do believe we will continue higher. I wouldn't doubt if right now, like I was saying, we are going to come down, balance this inefficiency right here, and at the exact same level, we have got ourselves another area of demand paired with that fair value gap, volume weighted average price, and we're resting at the point of control. That's where we get struggles. I don't like to take trades from the point of control. I like to take trades when it has expanded the range, and I take trades to the point of control. So the two market cycles, our price becomes imbalanced, and then it's always seeking to become balanced. When price becomes imbalanced and I see my entry model appear at a key level, then I take the opposing counter trade back to the point of control. Or if it was a long, I may entertain value area high or value area low in a short case scenario. But point of control is always your safest take profit. So tonight, right at 8:30, I'm always speaking about how 8:30 p.m. something magical happens in the Asia market, where there's always a key reversal right at that time. Again, this was super sideways. I really probably wouldn't have played in this at all. But 8:30, we had a bullish SMT with the Dow Jones. Let's turn on the volume footprint chart. So this is going to look confusing, and this is how you can also pair which fair value gaps are likely to be respected or rejected. This is when you kind of take it to the next level, when you start looking at the volume profile of each specific candle as well. So each one of these highlighted areas marks 500% imbalances. So each one of these tick levels, tick level meaning 25 cents, is representing 500% more bullish participants than bearish participants. So if we come down into these levels, we left a wickless candle right here. So we are likely, if we have a red CVD, I'm willing to bet that this is just going to be a resweep, and we may tag into these imbalances and then reject. We could pump higher. It's pretty unpredictable right now with the volatility, but you'll notice that, like, now I want to delete this volume profile so it's just not in our way. But in this area right here, this was an area of demand that got created from you could go to the wick low or the candle body low to, I generally on a low time frame, like the 1 minute, I go wick to wick. So we have an area of demand, and we have not large, but bullish imbalances with a point of control from the previous session resting right in this line. And so we tagged back into that area of demand with a huge bearish candle. This right here would have gave great confluence for shorts. We did hit point of control. So if you had shorted, I want to see if there very well may have been my model right there on a very low time frame to have taken it, and there kind of was. I require a bearish CVD divergence, which is shown right here. From this candle's high to this candle's high, price went higher than on the CVD chart. It showed less bullish participation in this candle that pushed it higher than in this. There was more bullish participation in this high that formed. This looks incredibly confusing, but if you look through some of my other videos, you can begin to understand this, or if you just follow along with the live trading, it will become clear soon. And then on top of that, we have on an even lower time frame, I'm just scanning over so I can get that volume profile to reappear. On an even lower time frame, right when we had so we pushed open. Let's see from here. So we do have opposing, these are both CVD charts. Following this down, I've got prices making a higher high than these candles to the left. But what do we see on the CVD? We see a lot more bullish participation in this little candle down here than we do in this expanded candle here. So even though it didn't get marked from here to here, that's a CVD divergence. And that wick, even though we have large bullish participation, is showing passive absorption from this imbalance level. So when we tagged back into that imbalance level from this candle over here, all these stacked imbalances, we're rejecting those levels. That was short sellers, smart money, stepped in at those levels. And this is how you gauge if you're on the right side of the aisle. You want to be riding in the vehicle passenger of smart money. You don't, and taking trades with them as a passenger. Let them drive the vehicle of price. We're just hopping in the car. You don't want to be driving into a head-on collision with them because they're going to run you over every single time. We're not trading with millions of dollars. So we did have ourselves a bearish CVD divergence right here. And then I would have needed to see right here, we also formed this bullish candle that has below it a red delta. So there was more short sellers that were already stepping in right here, and they were absorbing all of this bullish participants, all of the bullish participants. These three candles closed with a red delta. We then formed an obvious CVD divergence. Even though these two had a green delta, we wouldn't have entered really off of any of this because this candle had ripped all the way to the target as soon as it had opened. But in a hypothetical, if this candle had opened and closed down here with bullish imbalances extending off of it like we see here, you could have taken the short right off of that. That's telling you that short sellers have now taken control of price. Buyers have become exhausted. They are struggling to hold on, and that we are going to go rebalance. And we did. We didn't make it down to value area low. But look where we closed, right on that yellow point of control line. And from there, again, I don't take trades from the point of control. I would have seen price reach up here. And we're at value area high now, right? And on this lower time frame, even though we had a bearish CVD right here, we also had a delta divergence. I would need to see this candle open and close with these imbalances, and then I would need to see this candle come into those imbalances and have the delta turn red. Then I would enter short. As soon as this candlestick pushes through these imbalances, this is no longer valid. So I would just sit and watch this play out, and I would anticipate a resweep, which we got. So bulls keep coming up, and they're getting passively absorbed right at value area high out of these stacked bearish imbalance levels right above. Things that you don't see in SMC concepts. It's only telling you half of the story. This is how you can learn to really read the auction. It seems very, very complicated, but with time, you can do this. Like a month, you'll be reading this like a pro if you're in the live trading sessions. And they're all free. I don't want $1 from you. So, again, rejecting. Let's find the trade. I guarantee that we could have had the model appear to take this, even though, again, I'm not really interested in this market condition. I don't get fear of missing out anymore. But, you know, if you're actively hunting trades, this is the safest way to do it right now, in my opinion, or another institutional grade model. So we have a high right here formed. And again, on the CVD chart, we are showing regression. Bulls are dying out. So we don't necessarily have a CVD divergence. Let's find one in between. There'll be one in between two candlesticks, and you could go off of that. But right here, you've got it. This bearish candle pushed higher at one time when it opened bullish, and it pushed higher than this bullish candle to the left, right? And down following my vertical cursor line, we formed this high on the histogram chart. This is a CVD histogram. There was more bullish participation. We had a green delta, but it's very weak, very low number. That's almost back at zero. That's only 38 more bullish participants in this candle than shorts. So a lot of volume. Next candle pushed higher, but there was less bullish volume, but the price went higher. So that right there is a bearish CVD divergence. And then do we have, so we've had multiple delta divergences. I would entertain that trade, but again, point of control is so close. I like a more expanded range. We've only moved 62 points in tonight's Asia session, and we have a 5-day average of 221. So again, I don't think I'm making the wrong decision by sitting this out. New York had some good-looking trades, but I really don't care that I missed out on them. Not in a rush. So if we had a larger range, when this candle opens up, and we have this one that, was this just a wickless candle? No, we had a little bit of a push up. If you see this pushing up and we're maintaining a red delta, this is also too how you have a bigger position with a smaller stop loss. You could have entered right at that candle's high, stop loss above these imbalances, because if your trade idea is correct, you should not push through these imbalances. You should be A-OK to at least the point of control. That's a 1-to-1. I really wouldn't have been interested in that. You may have even been able to get all the way to value area low, which we didn't. It would have come back at you. But if you were to, hypothetically, you could have targeted the value area low. And in good market conditions, these happen all the time, but there's usually a larger range. So my average trade is like at least a 3R or a 5R. A lot of times we're hitting 8 or 10Rs in great market conditions. Last week I had an average profit factor of almost 11. It was like 10.34. So my average trade was over 10R and using this model. And again, very confusing, but this is how you weight what fair value gaps are going to hold and be respected and which ones are not. Let's go to a higher time frame so it's much less confusing here. Super, super ugly on the 5 minute, but let's look at this, right? So I only have my settings set to highlight areas. These blue dots on this candlestick are still representing 500% imbalances. And then what do we have? We have a low volume node even on these. So like this again, I know I'm throwing a lot at you, but you learn this like an onion and you start peeling back the layers of the onion. What is price and what is the auction and how it operates, right? So we displaced right through bearish imbalances. We created this bullish fair value gap. This is a 5 minute. And we also have a low volume node right down here. So we are likely to return to balance price out at this range. I'm willing to bet it. You know, the more price action that I show on screen, where do we have the volume weighted average price resting, right? It's showing that price to be balanced is going to come back here. We also have these two green highlighted areas that I have are unfinished auctions. Price took off so fast that at these specific levels, it never finished filling the orders of shorts or longs. So the bulls just took control, grabbed it by the reins, and ran with price. So either way, I'm going to wrap this up because I don't want to make this never-ending session here. I could just go on and go on. But that is a brief glimpse into how you can judge which fair value gaps are likely to be respected and which ones are likely to be disrespected, even on a normal candlestick chart using a volume profile. Usually in better market conditions with clearer expansions, these lower volume nodes are going to be more predominantly laid out for you. If there was absolutely no volume in this space, and this basically the volume profile had just come back to almost closed, you can pretty much guarantee that price is going to accelerate through that area and go to the next target, whether that be value area low, POC, whatever it may be. But it's most likely just going to flush through it. And if you see where we had participation, but much less, this will likely be an area of support because buyers and sellers were interested at these levels and they will likely be again. So great ways to gauge. I would assume that we will end up coming down here, probably wicking to the point of control and then returning and closing in a 5 minute candle within that gap. That's my assumption. I'm calling it now. But either way, to everyone that has stayed, I thank you very much. If you have any questions at all, please hop in the Discord. I'm in there live trading multiple days a week. If you don't mind, please give me a like and subscribe. If you've made it this far, I would greatly appreciate your help trying to grow the channel. I don't want anything from anyone. I just want to help you all develop to be able to be traders that are self-sustainable. So thank you again and have a great rest of your night.